Good evening. We begin tonight with a significant development in global commodity markets and international trade that is drawing attention from financial analysts and institutional investors around the world. Silver, the precious metal that has been closely watched throughout early 2026, closed the New York trading session on Tuesday at $89.37 per ounce, a gain of 2.1% on the day. What makes this closing figure particularly noteworthy is the context in which it occurred. Across the broader commodity complex on Tuesday, markets experienced substantial declines. Crude oil fell by 8%, settling at $72 per barrel. Natural gas dropped 11%. Copper declined 4.6%, and platinum fell 3.1%. Despite this widespread sell-off across energy and industrial commodities, silver not only held its ground but closed higher, a divergence that market observers are describing as a significant decoupling from traditional commodity correlation patterns that have governed precious metals trading for approximately 4 decades. Simultaneously, China released official trade data on Tuesday that is being described as a record-breaking figure. The People's Republic of China reported an all-time record trade surplus of $214.3 billion, driven by a 22% surge in Chinese exports compared to the same period last year. This announcement has captured the attention of global markets, with particular focus on how those surplus funds may be deployed across international asset classes in the coming hours and trading sessions. To understand the full significance of Tuesday's developments, it is necessary to examine the sequence of events that has unfolded in global financial markets over the preceding 16 months, beginning in October of 2024 and continuing through to the present date. That timeline provides the essential context for evaluating both the silver market's behavior on Tuesday and the implications of China's record trade surplus announcement. In October of 2024, the United States Treasury market experienced what has been described as its worst quarterly loss in recorded history. The 10-year Treasury yield spiked to 4.9%, and the 30-year yield reached 5.2%, levels not seen since before the 2008 financial crisis. These yield movements were driven in part by the Federal Reserve raising its benchmark interest rate to 5.75% in an effort to address persistent inflation. For foreign holders of U.S. government debt, including China and Japan, the resulting decline in the market value of their treasury portfolios represented hundreds of billions of dollars in losses over a matter of weeks. It was against this backdrop that China began what analysts have since described as a systematic rotation out of U.S. Treasury securities and into physical precious metals. According to the latest Treasury International Capital report, published approximately 3 weeks prior to Tuesday's session, China's total holdings of U.S. Treasury securities currently stand at $640 billion. That figure is down from over $1 trillion as of October 2024, a reduction of approximately $350 billion over 16 months. The People's Bank of China has been identified as having liquidated that volume of American government debt and redirected those funds primarily into physical gold and silver purchased through the Shanghai Gold Exchange. The Shanghai Gold Exchange is the world's largest physical precious metals marketplace. Unlike futures exchanges operating in New York and London, the SGE operates under a strict physical delivery mandate. Every transaction executed on that exchange requires actual metal delivery within 2 business days. There are no cash-settled contracts and no unallocated certificates. When a purchase is completed on the SG, physical metal is transferred to the buyer's vault within 48 hours and is removed from the global supply chain. That metal does not re-enter Western lending or rehypothecation systems. According to exchange data, the Shanghai Gold Exchange reported record physical delivery volumes throughout 2025, with over 4,000 metric tons of gold clearing through its system during that year, representing approximately 40% of total global mine supply for the period. China's accumulation activity has not been limited to central bank reserves alone. State-owned enterprises, sovereign wealth funds, and commercial banks have also been active participants in physical metals acquisition during this period. Gold-backed savings programs for retail citizens were introduced, and gold-backed financing instruments for infrastructure projects were implemented, forming what analysts describe as a broader parallel financial architecture built on hard assets rather than debt instruments. Continuing our coverage, we turn now to the supply dynamics currently observed within the futures and physical delivery infrastructure of Western precious metals markets, and what those conditions may mean as Asian trading sessions get underway. According to the most recent warehouse stock report, the COMEX registered inventory, defined as the physical metal officially available for delivery to settle futures contracts, currently stands at approximately 72 million ounces of silver. Against that figure, the COMEX carries an open interest position of over 900 million ounces. That represents a leverage ratio of approximately 12.5 to 1, meaning that for every single physical ounce sitting in COMEX warehouse facilities, there are 12.5 paper claims outstanding against that same ounce. Analysts covering the precious metal space have noted that this registered inventory figure represents a 64% decline from the levels recorded in October of 2024, when deliverable metal stood at over 200 million ounces. It is within this context that observers are examining what a meaningful allocation of China's $214 billion trade surplus into physical silver could mean for available supply. To illustrate the scale involved, if China were to allocate just 5% of that surplus towards silver purchases at current prices of $89 per ounce, that would represent approximately $10.7 billion, sufficient to purchase roughly 120 million ounces of physical metal. That figure exceeds the entire current COMEX registered inventory of 72 million ounces. Even a more conservative allocation of 1% of the surplus, approximately $2.14 billion, would purchase an estimated 24 million ounces of silver at current prices. For context, the Shanghai Gold Exchange typically records between 10 and 15 million ounces of silver in trading volume per session, meaning a 1% surplus allocation would represent nearly double the exchange's average daily volume. Beyond central bank reserves, Chinese state-owned enterprises, sovereign wealth funds, and commercial banks have also been cited as active participants in physical metals accumulation during this period. Additionally, gold-backed savings programs for retail citizens and gold-backed financing instruments for infrastructure projects have been reported as components of a broader strategy to build financial architecture supported by hard assets. Turning to the technical picture for silver as Tuesday's session concluded, traders and analysts are pointing to several price levels that will be closely monitored when North American markets reopen on Wednesday morning. The $89 level, which silver successfully defended throughout Tuesday's session despite the broader commodity sell-off, is being characterized as a critical support threshold. Prior to Tuesday, Silver reached a high of $93.50 in February before experiencing a decline back to $82 over a 3-day period. That February high of $93.50 is now being cited as the first significant resistance level on the upside. Beyond that, $97 has been identified as a major psychological level in the upper boundary of the long-term ascending price channel that silver has traded within since breaking above $70 in December of 2025. Silver's broader rally from $29 per ounce in August of 2025 to its current level of $89 represents a gain of approximately 207% over that period, a performance that has outpaced gold's 55% gain over the same time frame by nearly 4-to-1. As we bring together the threads of tonight's coverage, we turn to the broader macroeconomic environment within which Tuesday's commodity market developments and China's record trade surplus announcement are unfolding, beginning with the Federal Reserve and its upcoming policy decision. The Federal Open Market Committee is scheduled to convene its next policy meeting on March 31st, 2026, approximately 3 weeks from tonight. According to the CME FedWatch tool, markets are currently pricing in a 72% probability of a 25 basis point interest rate reduction at that meeting. However, the most recent consumer price index data, released last Friday, showed core inflation accelerating to 4.1% on a year-over-year basis, a figure that remains significantly above the Federal Reserve's stated target of 2%. That gap between current inflation readings and the Fed's policy target has introduced uncertainty into the rate outlook, with some analysts raising the possibility that the central bank may choose to hold rates steady rather than proceed with a reduction. The Federal Reserve's current benchmark interest rate stands at 4.5%, following a reduction from 5.75% that was implemented after a regional banking crisis emerged earlier in 2025. That rate cut had itself followed a period during which the Fed had raised rates to 5.75% in an effort to address inflation, a move that contributed to significant losses in the market value of U.S. Treasury holdings held by foreign central banks, including China and Japan, during the fourth quarter of 2024. The condition of the United States Treasury market remains a point of focus for international financial observers. The national debt currently stands at $36 trillion, with annual interest payments on that debt now exceeding $1 trillion, surpassing both the defense budget and Medicare expenditures to become the single largest line item in the federal budget. Annual deficit spending is reported to be growing by over $2 trillion per year. Treasury International Capital data indicates that foreign central banks have been net sellers of U.S. government debt, with China's holdings alone declining from over $1 trillion to $640 billion since October of 2024, a reduction of approximately $350 billion over 16 months. These Treasury market dynamics are unfolding alongside the development of alternative international payment and settlement systems being constructed by BRICS member nations, as well as reports that Saudi Arabia has begun accepting yuan-denominated payments for oil transactions, a development with implications for the petrodollar framework that has structured global energy trade for approximately 50 years. Against this backdrop, Tuesday's silver market close at $89.37 per ounce takes on additional significance. Silver has now risen from $29 per ounce in August of 2025 to its current level, a gain of over 200% in approximately 7 months. Gold, over the same period has risen from approximately $2,200 per ounce to over $3,400, a gain of roughly 55%. The COMEX registered silver inventory, as previously noted, has declined 64% from over 200 million ounces in October of 2024 to approximately 72 million ounces as of the most recent warehouse stock report. The Shanghai Gold Exchange has recorded all-time high physical delivery volumes in each of the past 6 consecutive quarters. The convergence of these data points, China's record $214.3 billion trade surplus, silver's decoupling from Tuesday's broad commodity sell-off, declining Western vault inventories, 16 months of documented Chinese treasury liquidation, and record physical delivery volumes on the Shanghai Gold Exchange represents the collection of developments that financial analysts and market observers will be monitoring closely as Asian trading sessions open in the hours ahead and as North American markets prepare to reopen on Wednesday morning. To summarize the key facts from tonight's coverage, China has reported an all-time record trade surplus of $214.3 billion, driven by a 22% year-over-year surge in exports. Silver closed Tuesday's New York session at $89.37 per ounce, up 2.1%, despite an 8% decline in crude oil and broad losses across the commodity complex. The COMEX registered silver inventory currently stands at approximately 72 million ounces against an open interest of over 900 million ounces. The People's Bank of China has reduced its U.S. Treasury holdings by approximately $350 billion since October of 2024. The Federal Reserve's next policy meeting is scheduled for March 31st, with markets pricing in a 72% probability of a rate cut, while core inflation reads at 4.1%. And the U.S. national debt stands at $36 trillion with annual interest payments now exceeding $1 trillion. These are the conditions shaping global financial markets as of the close of business on Tuesday, March 10th, 2026. We will continue to monitor developments as Asian markets open and will bring you any significant updates as they become available. For all of us here, thank you for watching. Stay informed and good night.